Hi guys, this is CA Balakrishna. In this video we will be discussing amendments of Paper-4 Corporate and Economic Laws which are relevant for May 2022 attempt. Basically there are no major amendments, all the amendments are very minor amendments and the number of amendments are also very less. There are just 10 to 13 amendments for May 2022 attempt. We will be completing this video within half an hour to 1 hour. Okay, with this let us start with the first amendment. From the chapter, the first chapter of the directors, that is appointment and qualification of directors. If you see under section 150, that is data bank of independent director, the companies have to select their independent directors from the data bank of independent directors which will be maintained by a particular authority. Now if a person has to include his name in the data bank of this independent directors, then as per rule 6 he has to qualify a self-assessment proficiency test that will be conducted as per rule 6. The amendment is not in section number 150, but the rules relating to section 150 is amended. Okay, we'll see. As per rule 6, to include the name in the data bank, he has to pass a online proficiency self-assessment test. Okay, this was there earlier also. Now there are certain exemptions to few people. Okay, these people, the names of these people can be included in the data bank even though they haven't qualified the proficiency test. That means they need not write the self-assessment test to include their name in the data bank. Who are those people? See, provided that an individual shall not be required to pass online proficiency self-assessment test when he has served for a total period of not less than 3 years as on the date of inclusion of his name in the data bank. Okay, all this was there earlier also. He should, have served for not less than 3 years as point A, point B. In the point A there is no amendment. In this point B there is amendment. Okay, first of all we will see who are covered in this point A. Such person should have acted as director or key managerial personnel as on the date of inclusion of his name in the data bank of which types of company? A listed public company or unlisted public company having paid up share capital of 10 crore or more, or body corporate listed on any recognized stock exchange or in a country which is a member of state of financial action task force on money laundering. Okay, all this was there earlier also. And bodies corporate incorporated outside India having paid up capital of $2 million or more, or statutory corporation set up under an act of parliament. If a person has acted as director or key managerial personnel for at least a period of 3 years in these types of entities, then he need not write self-assessment test. That is one exemption. Another exemption is, earlier it was said that if a person has worked in the pay scale of director, one second, yeah, if the person has worked in the pay scale of director or above in Ministry of Corporate Affairs or Ministry of Finance or Ministry of Commerce and Industry or Ministry of Heavy Industries and Public Enterprises and having experience in handling the matter relating to corporate laws or security law or economic law. Okay, to these types of people the exemption was applicable earlier. Now this has been stricken off entirely, and in the place of this exemption a new exemption is introduced. That means the new exemption is the person should have worked in the pay scale of director or equivalent or above in any ministry or department of central government or any state government and having experience in handling following matters. matters relating to commerce, corporate affairs, finance, industry, public enterprises, or the affairs related to government companies or statutory corporations set up under an act of parliament or any state act and carrying on commercial activities. Okay, if the person is having experience in these matters and has worked in the pay scale of director in any ministry or department of either central government or state government, then he need not qualify this self-assessment test for the purpose of including his name in the data bank of the independent director. And apart from that, another exemption is also provided, that is, to these types of people also the exemption is provided. Who are they? Provided also that following individuals who are or have been for at least 10 years worked as an advocate of the court or in practice as a chartered accountant or in practice as a cost accountant or in practice as a company secretary shall not be required to pass online proficiency self-assessment test. Okay, hope this is clear. In the clause B, the existing exemption was stricken off and in that place a new exemption is introduced. Okay, this is a minor amendment in rule number 6 relating to section number 150, that is data bank of independent directors, relating to proficiency test, self-assessment proficiency test. Next, that was amendment from first chapter. Next amendment, meetings of board and its powers. See, this is also a omission. See, if you remember, the meeting of board can be conducted either through physical mode or through video conferencing mode. But if the board meeting is conducted through video conferencing mode, in such a type of meeting, some 5 aspects cannot be discussed. Okay, in a board meeting that is conducted through video conferencing, some 5 aspects cannot be discussed. What are they? Approval of annual financial statements, approval of board's report, approval of prospectus, and audit committee meetings in which the audit committee discusses about the financial statements, and also approval of matters relating to amalgamations, mergers and demergers. These 5 type of matters cannot be discussed in a board meeting that is conducted through audio visual means or video conferencing. Okay, the government felt that these matters are very important and the decision relating to these matters must be taken in a validly physically conducted board meeting only. But due to this COVID, the digital environment has developed a lot. Okay, all the meetings are being conducted through online mode only. Thereby, even the government, to encourage this online meetings, it has omitted this rule. That means now all these 5 matters can be discussed even in a meeting that is conducted through audio visual means or video conferencing. Hope that is clear. The entire rule 4 is omitted now, and due to that all these 5 aspects can be discussed and the decision relating to these 5 aspects can be taken even in a board meeting that is conducted through audio visual or video conferencing mode. Hope this is clear. That was one of the amendment from meetings of board and its powers. Next amendment, companies incorporated outside India, foreign companies. There are 2 amendments in this companies incorporated outside India chapter. Both are minor amendments relating to IFSC. Okay, that is International Financial Services Center. Basically, government has granted exemption from certain sections. What are those sections? section number 387 to 392. These sections deals with aspects relating to prospectus. Okay, if a foreign company or a company incorporated outside India wants to raise money from public in India, then it has to give the prospectus, and there are various aspects that such a company has to comply with, which were discussed in section number 387 to 392. Now these sections, these 5 sections are not applicable to following companies. What are they? See, foreign companies and companies incorporated or to be incorporated outside India, whether the company has or has not established, or when formed may or may not establish a place of India in so far as they relate to offering of subscription in securities, requirements relating to prospectus, and all matters incidental thereto in the International Financial Services Center set up under section 18 of Special Economic Zone Act 2005. That means if a foreign company or companies incorporated outside India which are not having place of business in India raises money by listing in International Financial Services Center, basically you can simply understand that this International Financial Center IFSC is like Special Economic Zone for financial service providers. Okay, basically this is not the actual meaning, but for your understanding you can understand it like this: for financial services providers. That means basically who are the financial services providers? The major financial service providers would be banks, insurance companies, and stock markets. Now if any entity set ups their office or their company relating to this financial services in this IFSC, then certain exemptions are granted to them, and they will provide services not to Indians. Okay, they will provide services to foreigners who want to transact through India. Okay, to those people the services will be provided in the IFSC. Okay, basically in India there is only one IFSC which is set up in gift city of Gujarat. Okay, in the gift city there is IFSC. Now if any entity wants to raise money by issuing securities in this IFSC, then for such entity the provisions of section 387 to 392 are not applicable. Okay, why not applicable? Because for those entities there are separate regulations. Okay, RBI has issued RBI Ifsc Regulations, which will be specifically applicable for the entities which have established in IFSC. SEBI has introduced SEBI Ifsc Regulations. In the same way, our insurance regulator IRDA has also specified IRDA Ifsc Regulations. Okay, now the entities which are established in the IFSCs will be governed by those specific regulations. Okay, relating to prospectus and relating to advertisement, all those aspects. If those entities wants to raise money, the regulations specified in SEBI Ifsc Regulations will be applicable to them. Thereby exemption is granted from section 387 to 392 under Companies Act for those types of foreign companies and companies incorporated outside India which wants to raise money by offering securities in IFSCs. Hope this is clear. Okay, this is one of the minor amendment in companies incorporated outside India. Next amendment in the same chapter. See, if a foreign company operates through electronic mode in India, even in that case, it is deemed that such company is having place of business in India. Okay, and in rules, the electronic mode was defined. Okay, there are certain 5 points which are covered under this electronic mode definition. Now, to this electronic mode definition, an explanation is introduced which says that, see, explanation: for the purpose of this clause, electronic based offering of securities, subscription thereof, or listing of securities in the international financial services centers set up under section 18 of Special Economic Zones Act 2005 shall not be construed as electronic mode for the purpose of clause 42 of section 2 of the act. Okay, clause 42 section 2 defines foreign company. Okay, now if any company offers securities in India for subscription through electronically based mode in IFSCs, okay, in international financial service centers, then it will not be deemed that such company is operating in India through electronic mode. Okay, since it is offering securities in IFSC, the exemption has been given to such a entity. Okay, and giving offering of securities in IFSC has been excluded from the definition of electronic mode. Hope this is clear. This is the explanation. These are the 2 amendments in companies incorporated outside India. Next, SEBI LODR regulations. There are some major amendments in SEBI LODR regulations. There is one important amendment which is relating to risk management committee. We'll discuss that. First of all, amendment number 5 in SEBI LODR regulations. There is amendment in regulation 3 which speaks about applicability of LODR regulations. If you see, there is a minor change. The word the was replaced with a and who was replaced with which. That is not so important. Next, see, I'll read it once. Applicability of LODR. Unless otherwise provided, these regulations shall apply to a listed entity which has listed any of the following designated securities on recognized stock exchange. Okay, where the securities have to be listed: specified securities listed on main board or SME stock exchange, or previously the term used was institutional trading platform. Now SEBI has replaced this term with innovators growth platform. Basically, if you see, in the stock exchange there will be 3 platforms. One is main board, in which all the companies whose share capital is more than 10 crores will list their shares on the main board, and SME stock exchange, whose share capital is less than 10 crore will list shares on the SME platform. And there is another platform by name institutional trading platform. Earlier this platform was there. In this platform, the shares, if a company wants to list the shares on this platform, it cannot offer shares to public. Okay, only institutions can purchase the shares on this platform. Okay, public cannot trade on this institutional trading platform. But now the name of this institutional trading platform is replaced with innovators growth platform. Okay, even in this innovators growth platform also, the shares cannot be traded by public. Only institutional investors can trade the shares on this innovators growth platform, but the name has been changed. Why it was changed? Because SEBI has allowed only certain type of companies to list their shares on this innovators growth platform. Okay, companies which are encouraging innovation, you can say. SEBI is encouraging innovation. Companies which are working on innovation of the products can list their shares in this innovators growth platform. Thereby the term has been changed to innovators growth platform. There is a separate list of companies that has been provided. However, that is not applicable to us. Just you remember that the name has been changed from institutional trading platform to innovators growth platform. Next, and also previously the list of all the shares was given in all the securities was given in B. Okay, it specified non-convertible debt securities, non-convertible redeemable preference shares, perpetual debt instruments, perpetual and cumulative preference shares. Like this it was there. Now it has been striken off and replaced with single term, that is non-convertible securities. If any entity lists its non-convertible securities on the stock exchange, then LODR regulations will be applicable to such entity. Okay, and also any entity lists its shares on the innovators growth platform, LODR regulations will be applicable to such entity. Hope this is clear. And the balance remaining clauses are as it is, they are not changed. Next, in the regulation 3 only, a new sub-regulation was introduced, sub-regulation 3, which was not there earlier. It provides that the provisions of these regulations which become applicable to a listed entities on the basis of criteria of value of outstanding listed debt securities shall continue to apply to such entities even if they fall below the threshold as mentioned in sub-regulation 1A of regulation 15. This regulation 15 is not there in our syllabus, but regulation 15 says that from regulation 16 to regulation 27, these regulations will be applicable only if company has listed debentures of not debentures, debt instruments of value more than 500 crores. Okay, only for those types of companies this regulation number 16 to 27 will be applicable. But what this point 3 says is that even though the limit has fallen below this 500 crores, once these regulations were applicable to a company, they are always applicable even though the limit falls below 500 crores. Okay, there is no necessity to remember this regulation 15 since it's not there in our syllabus, but this is a just minor addition that has been made through the amendment. Okay, that was amendment number 5. Next, amendment number 6, risk management committee. There are some important amendments in this risk management committee. If at all he wants to test from the amendments, he can test from this risk management committee. Okay, he can either ask MCQs or can give some 3 to 4 marks question on this risk management committee. We will discuss this entire risk management committee once again. Risk management committee. Who will constitute this risk management committee? Board of directors will constitute the risk management committee. Okay, earlier it was said that majority of members of risk management committee shall consist of members of board of directors, but now it is removed and replaced that risk management committee shall have minimum 3 directors. Okay, and in these 3 directors, majority of them being members of board of directors, including at least 1 independent director. Okay, now the risk management committee must consist of at least 1 independent director, and in case of listed entity having outstanding SR equity shares. SR equity shares means superior voting rights. Okay, these equity shares have superior voting rights when compared to other equity shares. If at all the company is having outstanding superior voting right equity shares, in that case at least 2/3 of the risk management committee shall comprise of independent directors. Hope that is clear. Risk management committee must consist at least 3 directors, and of these 3 directors, majority must be, not majority, at least the majority must be members of board of directors, and at least one must be independent director in normal cases. In case the company is having outstanding superior voting right equity shares, in that case it must have at least 2/3 of the risk management committee as independent directors. Hope that is clear. This is the new requirement that has been introduced for risk management committees. Next, chairperson of risk management committee shall be member of board of directors, and senior executives of listed entity may be members of the committee. Okay, this is as it is. Next, the meetings of risk management committee. Risk management committee shall meet at least twice in a year. Okay, previously it was at least once in a year, now it is at least twice in a year. Risk management committee shall meet at least twice in a year. And quorum has also been prescribed. Earlier there was no quorum prescribed for risk management committee, but now quorum is also prescribed. See, subclause 3b, subregulation 3b, the quorum for meeting of risk management committee shall be either 2 members or 1/3 of the members of the committee, whichever is higher, including at least 1 member of board of directors in attendance. Okay, quorum is 1/3 or 2, whichever is higher. Next, the meetings of risk management committee shall be conducted in such manner that on a continuous basis not more than 180 days shall elapse between any 2 consecutive meetings. Okay, the gap between 2 meetings should not be more than 180 days. Hope that is clear. These are the 2 additional requirements. One is relating to quorum of risk management risk management committee, and the second one is relating to gap between meetings of risk management committee. Okay, it should not be more than 180 days. Next, the board of directors shall define the role and responsibility of risk management committee. Okay, as it was prescribed earlier, it is same. And may delegate monitoring and reviewing of risk management plan to a committee. Fine. Such other functions as it may deem fit. Such function shall specifically cover cyber security function. Okay, this was there earlier also. A new function is also introduced. What is that? See, provided that role and responsibility of risk management committee shall mandatorily include the performance of functions that are specified in part D of schedule 2. Okay, this part D of schedule 2 is not there for our syllabus. Okay, you need not learn this part D of schedule 2. Fine. Next, the provisions of these regulations shall be applicable to top 1000 listed entities. Okay, earlier top 500 listed entities were required to constitute risk management committee, but now top 1000 listed entities must constitute risk management committee on the basis of market capitalization. Okay. Next, the risk management committee shall have powers to seek information from any employee, obtain outside legal or other professional advice, and secure attendance of outsiders with relevant expertise if it considers necessary. Okay, additional power is granted to risk management committee. Okay, that was amendment number 6. And the amendment number 7, which is a minor amendment where or equal to is added. See, regulation 24 subregulation 5, which deals with corporate governance related to material subsidiary. Okay, a listed entity shall not dispose of shares in its material subsidiary resulting in reduction of its shareholding either on its own or together with other subsidiaries to less than or equal to 50% or seize the exercise of control over the subsidiary. See, a listed entity cannot dispose of shares of its material subsidiary, which results into reducing the share capital of this listed entity to less than or equal to 50% of shares of this material subsidiary. Okay, the term or equal to is added here. Earlier the term or equal to is not there, now it is added. Okay, that is a minor amendment. Next, amendment number 8 in regulation number 26, which deals with memberships of committee. Okay, now a director can be member of committees. What is the maximum number of committees in which a director can act as a member? It is 10. Okay, 10 committees, and such committees should be either audit committee or risk management committee, not risk management committee, stakeholder relationship committee. For calculating the maximum of 10 memberships, you have to consider memberships of only these two committees, audit committee and stakeholder relationship committee. Okay, this was there earlier also. What is introduced now? A small amendment. See, a director shall not be member in more than 10 committees or act as chairperson of more than 5 committees across all the listed entities in which he, the term she is also introduced here, is a director, which shall be determined as follows. Now while calculating this limit of 10, certain companies must be included, certain companies must be excluded. In exclusions, a new type of company is added. Let us see. The limit of committees on which a director may serve in all public limited companies, whether listed or not, shall be included. Okay, public limited companies must be included in the limit, and all other companies including private companies, foreign companies, and also high value debt listed companies and companies under section 8 of Companies Act 2013 shall be excluded. Okay, a new type of company, high value debt listed company, must also be excluded while calculating this list, the limit of 10. Hope that is clear. Next, regulation number 27 subregulation 2 regarding quarterly corporate governance report. Okay, earlier time limit within which the quarterly corporate governance report has to be submitted is within 15 days from the close of the quarter, but now the time limit has been increased 21 days from the end of the quarter. Okay, 15 days has been increased to 21 days. Okay, next, regulation 29 subregulation 1, prior intimation of board meetings. See, if in a board meeting you are discussing certain matters, then prior intimation of such board meeting must be given to the stock exchange. One of such matter is proposal for declaration of bonus securities. Okay, if in the board meeting you are going to discuss a proposal for declaration of bonus securities, then the intimation of this board meeting has to be given at least to 2 days prior. Okay, at least to 2 working days advance notice has to be given to stock exchange. Now in this some paragraph is deleted, that is the proposal for declaration of bonus securities where such a proposal is communicated to the board of directors of listed entity as part of agenda papers. Okay, this term is deleted now. That means now the board of directors is going to discuss matter relating to proposing of bonus securities, and such matter of discussion of proposing bonus securities is not specified in the agenda papers. Okay, even though the matter is not specified in the agenda papers, the notice of such meeting must be provided to the stock exchange. Earlier, the notice of meeting relating to discussion of bonus securities has to be given to the stock exchange only if such matter is specified in the agenda papers. Okay, that means while calling the board meeting, along with the notice of board meeting, you will also give agenda of the board meeting. In that agenda, if this matter is included, only then you are required to give notice of the meeting to the stock exchange. Okay, 2 days notice. But now, even though this matter is not included in the agenda paper, you have to forward the notice of the meeting to the stock exchange at least 2 working days. Hope that is clear. This is one of the amendment. Next, corporate governance report. Here just the terminology is changed. Earlier shareholders grievance committee was used and it was replaced with stakeholders relationship committee. Okay, some disclosures has to be given in the corporate governance report. Okay, disclosures relating to stakeholder relationship committee, these types of disclosures has to be given. Earlier the term used was shareholders grievance committee. Now the terminology is changed to stakeholder relationship committee. Okay, that's not a minor change. And additional disclosure requirement relating to risk management committee is also implemented through Subregulation 5A. Okay, now the corporate governance report must also include disclosures relating to risk management committee. What are the disclosures? Brief description of terms of reference, composition, name of members and chairpersons, meetings, attendance during the year. These 3 disclosures relating to risk management committee must be given in the corporate governance report. Okay, those were the amendments related to LODR regulations. Next amendment in Foreign Exchange Management Act. We can't call this as amendment, just a change of terminology. See, when exporter receives advance, then he has to pay some interest on this advance. What was the interest? Maximum amount of interest that the exporter can pay on the advance received. See, there is just a change of terminology. The rate of interest is same. Let me tell you here this point. Earlier the terminology was the rate of interest if any payable on the advance payment does not exceed rate of interest London interbank offered rate, that is LIBOR, plus 100 basis points. That means maximum rate of interest that can be paid was LIBOR plus 100 basis points. This was earlier. What is the new maximum rate? New maximum rate is also same, but the terminology is changed. See, this is the amendment. The rate of interest if any payable on the advance payment shall not exceed 100 basis points above the London interbank offered rate. Okay, same. The new one is also LIBOR plus 100 basis points only, but the terminology is changed. Okay, and see, shall not exceed 100 basis points above the London interbank offered rate or any other applicable benchmark as may be directed by Reserve Bank of India. Okay, Reserve Bank of India might specify instead of LIBOR you use another benchmark like NIBOR or MIBOR. Okay, you use another benchmark like this, the Reserve Bank may specify. This is a minor amendment. Okay, these are the amendments which are applicable for May 2022.